Hey guys, I'm looking at the OVX. I don't know if you guys have heard of this. This is the crude oil volatility index. I've done a VIX and a TVIX, and that covers the general volatility in the stock market crash. But this is something to look at. So here's normal oil volatility around 30s here, and then 40s, 50s is getting a little sketchy. Like this is a lot of the peaks when oil is getting dangerous. It gets to around 50s. Above 50 is really, really scary. And this is where we are here. We are in 100 to 500 land on oil volatility. This is terrifying. This means that oil is absolutely insane, and investing in oil is just nuts right now. It's absolutely nuts until this thing comes back down, and it has come down back down to 100, which is awful. Still, this is still completely dangerous and completely unstable for oil, and who knows, man? Who knows what we're gonna see? We could see another huge oil crash before we get anywhere down to a tradable, stable kind of level for oil prices. So I think this is a really important one to look at, and I guess I won't do inflation this video. I have people asking about inflation. I'll do that next video. This is Brian Lewis with MMT Investing, and things just changed. So this is the crude oil volatility. I'll get in on this thing, and let's draw our charts on this, and just check out when this kind of happened, and look at our crash. Because we had 20 here. See, we had basically like a record low volatility, not record low, but a low point and completely stable volatility leading into the crash. And the S&P did this 1, 2, 3 wave down, and or ABC, like an ABC Elliott wave down, and then it did kind of a 1, 2, 3, 4, 5 wave up, and now the S&P or the S&P is starting to turn over, and we're getting a kick in volatility on the S&P now, and we're getting a big decrease in volatility on the OVX, the oil volatility. And I haven't actually looked at this thing for any kind of technical analysis. The only analysis I was going to point out basically is like this level that we gapped up from is scary town. Like like where we were hitting this is dangerous and scary, where you should be really careful trading oil and oil companies. And up here, it's just absolutely freaking insane. And this has to do with the entire Eurodollar worldwide monetary system. This is the number one energy commodity that backs the worldwide system. You have the petrodollar system, that's been a huge, backing to that system and a big source of conflict for a long time. And now we have pretty much that entire system losing its backing, and oil prices are just going crazy. And we have Russia is backing out of OPEC, and Russia and Saudi Arabia are overproducing oil and trying to make it through this period, and all the other oil producers in the world are going negative, and I mean, all the companies are at risk of going out of business right now. I mean, that's what this means. That's what this is. And for everybody that's getting excited about oil and thinks it's at a low and a super investable point, I mean, it's really dangerous. This doesn't say if oil is going to go up or down. This just says oil is super dangerous, basically. And that was kind of the idea of this video. I just wanted to point out the oil volatility index and show that it's not really related to the. I mean, we did get this peak, and this peak is the same, and it is sort of inverse the S&P a little bit, like the general monetary system movements a little bit, but this insane volatility spike here is crazy. Yeah, this whole thing is just nuts. Like we got a big low in oil here, and then it's just too scary. The volatility is just too crazy. That's that. Um, please hit the like button and watch your oil volatility. If everyone, I mean, oil is getting so popular right now, and I just did a video on the USO, the United States Oil Fund, that people think that they're buying sort of into the price of oil because it's contracts for barrels of oil. It's like futures contracts, but the way that it's structured, it rolls over the contracts in the middle of every month. And when you have a current price lower than a futures price, you get the contango situation where the spot price of those contracts goes down. And basically, the USO is just selling those contracts at a loss and then buying the next contract at a high price. So even though the price of oil keeps going up, USO is just not getting those gains because it just keeps selling the prices at a loss, selling the contracts at a loss when it rolls them over. Um, so yeah, so holding USO long is not like holding the price of oil long. It doesn't track the price of oil on the way up, but it tracks the crash of oil on the way down pretty well. So you get just this kind of weird kind of flat and then a drop off kind of graph with the USO, and then all these other oil companies right now are just in so much trouble. I mean, they have a ton of debt and equipment to maintain, and if they produce a bunch of oil, they can't sell it, and there's nowhere to store it. And I mean, there's just so many sectors of oil that are in so much trouble right now. And like Russia and Saudis, like they can handle it they could probably put up with this crazy low prices and stuff for like 10 years. And they would come out alive and they would be the only oil producers left in business if they wanted to really try to do something like that. I mean, Russia is kind of threatening to do that. They have threatened to do that over the last few months. They've asked the UN, the US, the European Union. They talked to Italy. They've been asking everybody to take the sanctions off of their country, and they're like, we can handle these low oil prices. We can handle a super high DXY. Like if the dollar index goes really high and starts crushing everybody's currencies, it's not going to crush Russia because they're de-dollarized. They have a stockpile of gold, and they can produce oil at a very low price and a high volume for a very long time. So this oil thing that's happening, I mean, the shortest outlook is a couple of months. The longest outlook is like 10 years. And this will absolutely destroy the dollar system. And this is the major backing on the international dollar. So I do want to kind of segue into inflation here because this is definitely this situation dragging out would definitely factor into inflation in a big way. But as I'll go into in my next video about inflation, this is not going to cause inflation like this week because we're in the middle of a down cycle, a credit contraction cycle. That means there's less money. A contraction cycle means that you're calling in loans and people are trying to pay them, and there's less dollars in the system. So when there's less dollars, that is literally deflation, and across the whole world. And the Fed like pumping out, money on its balance sheet and trying to create liquidity in the international system right now is not blowing any of the stock market up or anything like that. They're just trying to combat the deflation that's happening in this down cycle right now. And then we need another inflation outlook after this cycle. And then we need to see if we're getting into a longer term bear market because that'll be a little bit deflationary pressure. And then we need to see at the bottom of that bear market what everything looks like because that is when inflation could really kick at the end of a bear market. Okay, so oil volatility and people getting excited about oil. It's not exciting right now as a value investment. As far as I'm concerned, this is not investment advice. But in general, things from a value perspective are not interesting until you get to stable volatility and you're in a bull market with stable volatility, then you can go long for however long you think the bull market will be, 7 years, 50 years, whatever. But this kind of credit contraction, backside of a bubble crash with crazy high volatility, is not a value investing environment right now. And it's not inflationary in the short term. And happy investing.